as people filter in, maybe I'll tell you about my recent trip to Rotorua. I was there on Tuesday to speak at a sustainable brands conference, and it was all about purpose and those kinds of things, which was really fun. But the highlight for me was actually going to have this thing called egg coffee. I don't know if any of you have had it, but it's kind of this Vietnamese coffee with this whipped custard that goes on top of it. It's the most incredible thing. So if you're in Rotorua, I highly recommend you check out egg coffee at a place called Saigon 60s on Fenton Street. Yeah, just absolutely phenomenal. Anyway, very high in calories, so maybe more of a treat rather than an everyday thing. Okay, so I think we've got everything going, and the technology seems to be working. So the usual plan, this is an opportunity for you to kind of ask your questions. We've had some questions already, which I'll try and answer as I go through a little update on what's happening in markets and the economy. So we are on Zoom and YouTube. So if you have any questions, please pop them in the Q&A in Zoom or in the comments in YouTube. So we'll take it from there. So give me about 15 minutes and I'll take you through a little bit of an update on what's happening in the economy, what's happening in markets. I'll also quickly touch on the stuff around how we invest that we talked about last time. But I know that because of the technology issues, because my colleagues at the office had a fire drill, and so we had some issues. So I'll just take you through that just one more time for those of you who might not have been able to see it. So, as you know, we are a regulated entity, so we just need to give you an explainer when we start. And it's really the main thing that the things that we are talking to you about is for general information. It does not relate to your particular financial situations or goals and is not financial advice or recommendations. And we'll talk a little bit about our products and schemes, and those disclosure statements are available on our website. So please have a look at those if you do have any concerns or queries. Before I start, I just want to say a big thank you to all our members. We can't do any of this without you. What we do is for you. The big thank you is we have just ticked over 170,000 members, which is an extraordinary achievement. So I was involved very early on in KiwiSaver as a board member of KiwiSaver. And I remember when Sam came to see me and said, we're starting this new thing. And it was really just, it was such a dream at that phase to see that actually working, and to be working in that team now is pretty exciting. We were also in the Good People's Choice in the Consumer Awards, the sixth year running. And if you also want to have follow us along in terms of our views and questions and queries, you can. We've got a couple of podcasts as well. My colleagues Liv and Jenny have been doing Money Made Simple, which I've been a guest on. And more recently, I've started my own one with the team, which is called Economy Made Simple. And we just recorded our latest two sessions, one on explaining the government's finances and the other around the housing market. So watch out for those, and they'll be coming to you shortly. A couple of things, well, the big things I want to talk to you about today is it does feel like the world is still very uncertain, and I think you're absolutely right. What's uncertain is we're living through this period of change where the world is shifting from one where we had some rules and norms that seemed like they were stable. Those things are being upended, whether it's around geopolitics or around politics or the way we do politics. All of those things are being moved around very quickly. This is, of course, affecting KiwiSaver. And in the last couple of sessions, we've talked a lot about the volatility and the weakness in markets. Those have rebounded quite a lot, but the volatility is still very real and uncertainty is still very real. And I'll remind you again that it's really important for us to think about what are the kinds of things we can control, because when it comes to long-term savings like KiwiSaver, we do have to make sure our horizons are matched with our behaviors. And that quite often means making sure we are really clear about what kind of risks we're able to tolerate, making sure we're in the right kind of funds, and we're making the right kinds of contributions over a long period of time. Locally in New Zealand, because we're all here, if you're a KiwiSaver member, of course, you are employed in New Zealand and you're contributing to your KiwiSaver from that income. What we're starting to see is that economic weakness, it's not over yet, but we're just starting to see the beginnings of the bottom of the economy. Whether it's the amount of concrete being poured or the number of jobs, things are not yet getting better, but they're not getting worse. And that gives me a little bit of comfort. We do have the budget that's coming out very shortly on the 22nd of May. It might have an impact on KiwiSaver, in particular around government subsidies on KiwiSaver contributions. So, my feeling is that if you haven't already made sufficient contributions to get the government support, which is about, I think, $1,024, if you can afford to do it, please do it before that budget because you are unlikely to be affected by it if the rules change when the budget comes through. So, why should you not take advantage of that subsidy if it's still available? So, in terms of markets, they've just been on this massive, massive, I guess, roller coaster ride. On the left-hand side is this measure of uncertainty that they do in the US. It's the policy uncertainty there. And what you can see is that over the course of the last couple of months, we've seen this extraordinary explosion of uncertainty. And that's because of this, the huge number of executive orders from President Trump. The types of policies that he's pursuing are really quite unknown in the modern era. And it's eased back a little bit as if you have been following the news, you would have seen that a lot of those tariffs have been reduced, particularly the big one, which is between the US and China. That seems like that might be coming down. So, they have announced that they will renegotiate those tariffs, which is a really good thing because it was a big risk to New Zealand. And you can see that uncertainty just easing back a little bit, but it's not a lot. But you can see how much financial markets have rebounded. I drew that line for when the Liberation Day happened, and you can see that we have kind of rebounded across the US markets quite quickly. The New Zealand market is still below where it was when we started the year, but the European market has been growing really, really strongly. So very uneven impacts. And what markets are telling us is that there is still some uncertainty, but some of the bad news that had been baked in, that these tariffs would linger, that the economy would be in recession, that it might really create long-term problems, some of those fears have eased. But not everywhere. So, it's not just equity markets. We also look at what's happening in commodities, what's happening in interest rates to give us a sense of what are market pricing telling us. And right now, what we're seeing is that there is still a lot of concern around the global economy. On the left-hand side is a picture of crude oil price. And typically that will come down when there is less confidence around the economic outlook, global economic outlook. Less demand, we consume less oil, oil prices come off. Also, at the same time, we've seen the big oil producers saying we want to pump more oil, not great for the climate, because the prices are down and we need to have enough revenue to be able to pay for the things that we want. On the right-hand side is what's happening with gold price. Now, gold is one of those inverse kind of indicators. When world is uncertain, when there's a lot of fear, gold prices tend to go up a lot. And you can see that on the right-hand side that gold prices really spiked up in the last year, and they have come back just a little bit off the back of the recent announcements, but not a huge amount. So when you take it all together, what's telling us is that we went from having this really quite volatile period, that volatility lingers, but some of the immediate fears around economic outlook have eased. Partly that's because of, I guess, not just the policy uncertainty, but in the backdrop, we've also got that positive influence from monetary policy. So government policy is still uncertain, but monetary policy, by and large, is more supportive. It's for two reasons. On the left-hand side is what you're seeing in terms of inflation. We had that synchronized increase in inflation through that period of COVID and the bit after, but it's now kind of within the target band. It's still at the higher end, but it has come down. So most central banks around the world are targeting 1 to 3% in inflation rate, and currently it's hovering around the 2.5% mark. New Zealand is no different. On the right-hand side, you can see the kind of synchronized change in interest rates as well. So through that period of high inflation, we went very high very quickly. And then over the course of the last year or so, we've seen interest rates starting to come down. Now, we're also seeing a bit of a divergence. Interest rates have come down a lot in Europe because the economy has been weak and inflation is believed to be under control. Whereas in New Zealand, you can see while our interest rates have come down, they haven't come down quite as much yet. But we know from the Reserve Bank's language that we should expect a bit more support there. So as interest rates come down, we should start to see more relief in the New Zealand economy. It takes about 12 to 18 months for that to flow through. And that's probably why we're seeing this sentiment gradually improving, and it is still very gradual. And so the things I look at is not just what people are saying, but what people are experiencing and doing. And so that's what these two charts show. I think I've shown you these charts before. On the left-hand side is what consumers are saying about their finances. In the gray line is the people saying that I think my finances will improve next year. That's why it's so positive. But the green line tells you that their current state of finances is still pretty tough. And we're seeing this with other indicators like Centrix and others are telling us there's still a high level of financial stress, there's still a lot of hardship. And I think that's true. We're seeing that because the cost of living for necessities is still high when it comes to mortgage rates, when it comes to food, transport, utilities. Those are still taking up a big chunk of people's incomes. But we're seeing some relief with mortgage rates coming down as people refinance. On the right-hand side, you can see that businesses have been very optimistic for the last couple of years in the gray line, but the green line was what they were actually experiencing. That had been pretty bad and pretty tough. And that's what the recession was about. That's why they weren't advertising the jobs. That's why they were not hiring. But you can see even that is now starting to pick up, and they're seeing their actual sales in their business starting to improve. That's usually a precondition before I guess, the positive kind of cycle kicks in when businesses see their economy, their own business improving. As a result, they start to hire more people and invest more. That kickstarts the wider economic cycle that we are waiting to see. So when it comes to households, we're not quite seeing that recovery yet. What we're seeing is a bumbling along the bottom. And that's that, people are still doing it pretty tough financially. Not everyone, of course, but probably the large majority of New Zealand. So it's not just people who are unemployed, it's people who are on low paid income, low paid jobs, but also people who are middle income. So it's a larger swathe of New Zealanders that are doing it pretty tough. You can kind of see that on the picture on the left-hand side. That's retail spend on electronic cards per person per month. And you can see that trend upwards from 2015 to about 2022. And those big volatile bits in 2020 and 2021 was when we had the lockdowns because of the pandemic. But over the last 2 years, you can see that spending really fell and they rose a little bit at the end of last year and then they've fallen again. So things are still feeling a little bit, I guess, bumbling along the bottom rather than a strong recovery kicking in. Where we are seeing some recovery is on the right-hand side, which is house sales. Now, we're a housing-obsessed country, as you know, and you can see that during the period of pandemic around 2020, 21, we saw this surge in house buying. And that was because interest rates were low, banks were lending lots of money to buying and selling second-hand houses, not for farms or businesses, only for buying second-hand houses. And that really lifted everything up. But as interest rates rose, that fell very sharply, and you can see that fell. And over the last year or so, that's starting to increase again. And that's usually a sign that those who are at the margin, those who can afford it, are back in the market and starting to do things, but not in a big way, not high levels of activity, but certainly less negative than we had experienced. Part of the reason why I feel, I guess, that this recession has been a little bit different is while there has been a lot of hardship, so we should not deny that. What we're seeing is that this recession has been probably a little bit shallower than what we had experienced during the GFC. So I don't know if you can see that job losses in 2008, 2009, that was quite sharp. That's the GFC, that was the global financial crisis. That was quite sharp. And it took us about 5 and a bit years to go back to where we started. If you look to the right-hand side of the chart of monthly employment, you can see that, yes, we've had job losses, but peak to trough, we've lost about 30,000 jobs. And during the GFC, it was more like 50 odd thousand. So quite a big difference in terms of the extent of job losses. What we're not yet seeing, even though businesses aren't firing people in a big way, what we're not seeing is a beginning of the rehiring and filling of vacancies. So I look at the picture on the right-hand side quite closely. That's the number of job ads from businesses. That's when I'll be really confident that this recovery is strengthening. Because once businesses start hiring and advertising for jobs, it means the recovery has really got legs. So that's the indicator I'm looking for. And right now, that's still saying things are pretty tough. Now, it's not just about the domestic economy. So if you think about our economy, there are kind of three big domestic sectors. One is the households, the other one is government, and the other one is the kind of investments we make. And then there's the exports and external sector, which is around exports and tourism. Those were the kind of the two big things. And you can see on the left-hand side, the number of tourists coming into New Zealand has rebounded after the borders reopened, but the current level of tourists coming into the country are still much lower than it was pre the pandemic. So it's got a very mixed effect across different parts of New Zealand. In places like Queenstown, things are still very, very strong. In fact, they have rebounded very strongly. But in other parts of New Zealand, we're not seeing enough visitors to take us back to where we started. So it's that very much a mixed fortunes, even on this external sector. And on the right-hand side, you can see the share of goods exports. So this is our major exports of meat, dairy, forestry in particular. Those have been doing really well in the last 12 months or so. And you can see the share of the exports as a share of GDP has really bounced up after having a very tough year. So we're starting to see some of the kind of mixed signals that this recovery, while not yet uniform, it is starting to kind of pull together. We had data just, I think, yesterday on immigration, and that was quite interesting. Essentially, immigration is one of those, I'd say, sugar hit sources of economic growth for New Zealand. When we have lots of people coming in, it kind of creates economic growth, but it doesn't necessarily mean that we're going to get richer. So there's more people, doesn't mean we are better off. And essentially, what happened after the pandemic, once we reopened the borders, we saw a big surge in migrants coming in. You can see the picture on the left-hand side, and it slowed very sharply. It's just picked up a little bit in the last few months, 2 to 3 months. But on the right-hand side, you can see the other side of the picture is while we've got non-New Zealand citizens coming into the country, the outflow of New Zealanders going particularly to Australia has really escalated. And that's the picture on the right-hand side. You can see that net migration of New Zealand citizens was positive during the pandemic era, but really it's gone back to pretty negative rates. And it's kind of all kind of aged ranges. We're seeing people everywhere from 30s to mid 40s going over. So not just young people going on their OE, but it's a broader group of people. It's a little bit of a concern for me because we're losing people who really are important for New Zealand. It's that hollowing out of the middle, the kinds of people who pay most of the taxes, who do the work, who are the people who are really going to be the future leaders of our sectors and businesses and community. So we've got the budget coming up on the 22nd of May. We're going to see a lot of big jargon being thrown at us over this time. And some of the things that I think it's good to remember is that when we talk about budgets, quite often it'll be focused on the additional incremental amount they're going to spend this year. But it's conflated across this wider thing of government, which is very big. It's spent something like, I can't remember the exact number, but something like $160 billion a year. And you will hear that, oh, New Zealand borrows too much money. And I think that's a bit unnuanced. What I mean by that is it's okay for us to borrow money if it's for good quality investment, but it's not okay if you're repeatedly borrowing money to spend for operating spend. And that's kind of what I'm trying to show you on the picture on the left-hand side. Those green bars is the balance between operating spend and operating revenue, which is mainly tax revenue, less spending on things like health, super, welfare, and things like that. And so essentially what you can see is in the last few years, we've been using a lot of debt for operating spend. The orange bars is the money that we've been spending for infrastructure investment or capital investment. I don't have a problem with that. It's more that there is an issue when we're borrowing money for operating spend because we're spending more than we earn. So that's probably what I'll be watching out for is the balance between revenue from government and the operating spend and what we're borrowing and what we're investing. The big announcement that's probably relevant to members is probably around the KiwiSaver subsidy that we get, which amounts to about $1 billion a year. Could it be changed? That's what we've heard from the finance minister. So at the moment, you get an annual subsidy of $521.43 if you make the contribution over $1,024, I think. Now, part of the reason why that's happening, of course, is the coalition government promised to reduce taxes, reduce spending, and reduce borrowing. It was an impossible promise to keep. As a result, what we're seeing is they're clawing back on some other spend to be able to afford those tax cuts. And to give you a little bit of context, the income tax cut for the median earner was about $949 a year. So it's probably this, if the KiwiSaver subsidy is reduced, it might be half of that tax cut that might go away. There is a bigger issue at play here around governments. And I did this piece of work on social cohesion with the Helen Clark Foundation, which was on our last podcast. It's around the idea of, do we trust government? Because it's not just what government does, it's how government acts. That also matters. And what we're seeing is this erosion of following due process. And it's happening all around the world, whether it's in the US or whether it's here, we're seeing a bit of that. And that fills me with a little bit of concern. And it's a bit of a concern for me because in our survey, what we found was just over half of New Zealanders already do not think that government can be trusted. And while 81% of New Zealanders support democracy, 50 odd percent think that they should rely more on experts, and 32% support an autocratic leader. So when we see these kinds of attack on our institutions and democratic norms, I think there is a bigger kind of risk to New Zealand and our democracy than is just the kind of the one-offs of, or we should save some money here, or we should change a regulation here. There is a trade-off between the convenience of doing these one-off things versus this institution of democracy, the way that we run things in our country that might be being eroded away. And I feel very deeply uncomfortable about that stuff because I think that process, those checks and balances, taking New Zealanders with you is really important to ensure that we're driving to the same goal of making New Zealand more prosperous. I feel like there's a lot of attacks on our norms and institutions, which is problematic. Now, before you think it's me, my personal politics, it's not. I mean, yes, we are all inherently personally politically motivated, but it's also when you take a step back, you realize it's something that's been happening in a more persistent way. On the left-hand side is just the polling in terms of the lead over the right-leaning government versus the left-leaning coalition. And you can see the balance is very, very little. And it's really surprising because halfway into our first term, we should be seeing a much bigger lead. It's very unusual to be so deeply unpopular so early on in a term. And I think that's explained by the picture on the right-hand side, which is the net number of people saying the country is heading in the right direction or in the wrong direction. And you can see that there was a big fall off during the last Labour government, around that 21, 22, during that COVID period. We went from going, we're all in this together to going, actually, there's a lot of people in New Zealand who don't think we're doing the right thing. Even after there was a change of government, you can see that the fact that people still think the country is heading in the wrong direction. And that is really what I'm talking about around this attack on institutions and the norms is use of urgency, not kind of thinking about the wider group of New Zealanders is a really big risk. So when you're thinking about the budget, yes, of course, think about the issues that affect you directly and the specific policies, but also try and take a step back and go, is there something else that's happening that might be attacking the underlying principles of a democracy and the way we do things? Because that, to me, is probably a bigger risk for our future prosperity, something that I think we should try and protect. So very quickly, these are the slides that I showed you last time, but because of the fire alarm, we couldn't kind of get to quickly. So here's just a bit of a highlight. And if anybody would like the slides, just drop us an email and we'll get you a copy of it. Our investment philosophy and practice is very much around, it's around picking the asset allocation. So we just make sure that we are following the market in terms of what blend of stocks, bonds, and alternatives we have. And we try and get the average of the largest New Zealand KiwiSaver providers. We do provide a ethical screening, which is about just exclusions. So we're not actively looking for some things. What we're saying is there's certain types of investments that are bad, and we will not do that. And that's outlined in our responsible investment policy. And our big principle is we should be low cost. We'll try and kind of do this as cheaply as possible so that you can benefit from not having your returns being eaten away by high costs. We're predominantly passive. I think that's a better way to kind of describe it. It's in that we're not taking an active position in winners of stocks and whatever. So we're being really careful. We are making sure that we're tracking these screened indices away from those the ethical screening and as diversified as can be, both for shares and bonds. And again, that investment costs are low so that we can try and keep things cheap for you. This picture kind of tells you how we do the asset allocations in the kind of the different types of funds. So in the balanced fund, you can see we have a lot more bonds than equities. If you look at the high growth, it's a lot more bonds and a lot less of the other types of investments. So this is where you need to decide what is right for you and making sure you get the right type of investment. And this is just a representation of the unhedged global share fund for that we use. This is as of the end of March. And it gives you a sense that where those assets are. So you can see the American stocks are about 73% of all our portfolios as of the end of March. And then you can see all those other countries. And each of the squares is a specific company that we have stake in. So the diversification is both through the countries that we invest in and the types of businesses that we invest in. We had a question in the lead up to the webinar around are we looking to reduce our exposure to the US? It's a really big decision because many US companies are global companies. So just because we invest in the US market doesn't necessarily mean we're only invested in the US economy. So it's something that we're looking at really actively and strongly. So this is a topic of conversation in our investment committee. And we have those investment committees every month. So we will continue to have these conversations and we will keep you updated on if there's a change of policy, what we choose to do. And these are the three choices for individuals. I think the first is really around making sure that you're in the right KiwiSaver scheme and provider, the type of fund that you're in, whether it's a growth, balanced, etc. Just making sure that you have good advice to make sure that it's suited to your personal circumstances. And the final thing that you can really choose is how much you contribute. Is it the 3% employer plus how much you contribute on top of that, the minimum 3% or more than that. So these are the kind of the big choices that are in front of you. I think all the things that I've talked about are the wider economic, social, and market kind of context. And the decisions that we have to make are probably quite specific around what are the kinds of things we can do and what does that mean in terms of the long-term prosperity, the long-term goals that you have. So I'll stop there, and I know that we will have some questions coming through. So what I'll do is if you have any questions on the back of the presentation or just on anything else, pop it into the Q&A, and I will try my best to answer those. On this webinar today, Andrew Lance, our Chief Investment Officer, was not able to join me. Neither could Sam Stubbs because they're both traveling this week. But next month, we will make sure that there's more of us around to be able to answer any of your questions. So there was a question from Martin. I guess some might perceive simplicity living as picking winners. Is there information that compares returns with other investments? That's a really good question. And I think it's a question that we get often around how do we get the returns in a comparable way? And I think that I don't have a specific answer for you for that because we're still working through how we make sure the pricing is as transparent as possible and as comparable as possible. The difficulty is there isn't a comparable investment at the moment. So there is nobody else who's doing just build to rent all the way from conception to delivery. And what we're looking at, what we're seeing in terms of our experience of these developments is we're getting really good development returns. We're trying to manage our risks. We're doing all the things a responsible investor will try and do. But at the moment, the benchmark is difficult. One thing I think we could try and do is maybe compare it to listed property or something like that to give you a bit of context. So I'll take that to the investment committee next month. I think it's coming up next week to see if there's a way for us to be able to give us more transparency and a benchmark to be able to understand that. There's a question from Viv. Are there specific things that retired people should be considering with their investments at this uncertain time? That's a really, really good question. And I think the answer for me is probably twofold. The first is around the money that you have invested in KiwiSaver or in your managed fund. You're not going to use all of it tomorrow just because you're retired. You still have buckets of activities and time that's to come. And you need to plan to make sure that you have the right amount of risk and return expectations for those different buckets. So I kind of think about it in three buckets. The fun money that you want to use quite quickly, you want to go on holiday and do those kinds of things. The money you might need for the transition to, say, I don't know, some form of care, and the end of life stage when there are some expenses and the things that you might need to have a little bit of insurance for. So those longer dated things, I think it's okay to have that split into more aggressive things. But I think you need to make sure that you get good advice to make sure that those buckets of money that are for immediate use or near-term use are in lower risk and more appropriate types of funds. So It's not so much that I think just because the world is uncertain, you should put all your money into one basket, that you should still probably have some diversification that's consistent with your life goals and those stages of life that are still to come. Um, okay. Ellen has a anything else question. Okay, I like that. We recently withdrew a good part of a KiwiSaver savings account. What are the taxes that we paid at this stage? What are the overall taxes charged from A to Z, meaning starting at income tax, interest tax, and are there extra taxes on payout? Thank you. So I think my colleagues Liv and Jenny did a podcast on taxes very recently. My understanding of the KiwiSaver settings is we pay tax on the way in, so that your contributions are after tax. You pay tax on your returns. There is no tax to be paid on the way out because you've paid tax on the way in and as you've been invested. So there should be no additional taxes, as far as I know, when you take your money out. That's because that's the way that our KiwiSaver system was designed to ensure there is no additional large lump sum payments at the end of it. I hope that answers your question, but if there are any specific tax related questions, it really is worthwhile having a quick conversation with your accountant or the folk at IRD. I know it's scary sometimes to call the people at IRD, but I can tell you from personal experience, there's some absolutely wonderful people there, and they will help you out answer that question if you still have some further queries. Okay. Um, a question from John. What do you think of the concept of a capital gains tax or wealth tax as a way to reduce deficits without cutting expenditure? John, it's a really good question. And I think where I would start is rather than starting at the tax question, we should start at the spending question. And what I mean by that is first, I think we need to really decide what are the services that we want, the quantity and the quality of those services. And then we decide how much tax we want and how those taxes are collected. At the moment, what we have is this kind of upside down conversation. We go, we only want to pay this much tax, and how can we fit it in? And the temptation for our politicians is to promise unicorns. We're going to have lower taxes, we're going to have lower debt, and we're going to have more services that are better. Now, those unicorns don't exist, they're mythical. And I think therein lies the challenge. In terms of whether a wealth tax or a capital gains tax would be useful, and the answer is yes, they probably would be helpful in terms of broadening out our tax base. Compared to the OECD, New Zealand doesn't collect a lot of taxes. We are about the median, just below. But how we collect taxes is very different. It's very highly reliant on income tax, very highly reliant on GST. So it's really a tax on working and work rather than on the breadth of people who might be getting income from other sources like wealth, like capital gains, which is also income. So I'm not entirely sure that having those taxes in and of itself would solve our problem, mainly because the issue of tax in New Zealand is so politicized that even if you brought in a capital gains tax or a wealth tax, unless the public was really behind it, it wouldn't last. So we would probably see the tax being changed really quickly. What I call the control Z in a press undo policy is you get this volatility of policies coming in and going out with every change of government. And that's very disruptive as individuals and businesses. We actually want to have some predictability in our tax settings, our regulatory and policy settings. So then we're not constantly worrying about what is the government going to do next. We want to just get on with it and do our thing. So I hope that answers your question. It's a complicated answer, mainly because I think we are starting the conversation in almost the wrong way. We're starting with the conversation with tax rather than with the public services, the quantity and quality of those that we want. Until we agreed on those, I don't think we'll be able to decide how much tax we pay and how those taxes are fairly and equitably shared across New Zealand. A question from Helen. Hi there. I reacted to the most recent global uncertainty by moving to the conservative fund. I'm due to retire next year and had noticed a sizable reduction in funds over a short period of time recently. What are your thoughts on whether I stay with conservative or move to another type of investment strategy? Your thoughts, please. Look, it's a little bit hard to answer your specific question because we're not allowed to give you financial advice because I'm not a registered financial advisor. So it would be worthwhile having a conversation with somebody who's qualified to give you that advice because I think it's a really important conversation that you should have. The difficulty in these current environments is we don't know what the future holds and how quickly you might need that money. So, the question that we had at the beginning of this Q&A was also around for the advice for retirement. Is even if you're reaching retirement age, the reality is that you should be planning to live for maybe another 30 years. And that's a lot of time to be planning for. So not all of your money needs to be necessarily conservative. Not all of it needs to be tied up in one strategy. And this is where good financial advice can be really useful because it will make sure that your money is in the right buckets and it's for the right periods of your life. So I don't have a good answer for you only because I'm not qualified to give you that advice, but I would highly recommend you do reach out to an authorized financial advisor. They will be able to help you give good advice around what you do because I can absolutely understand the current market disruptions have had a big effect on a lot of people, and it can have a big impact on your life choices. The question from Mark Bourne. I have heard there is an ideal amount of tax revenue collected compared to GDP. Is that a good measure? And what is New Zealand's figure over the last few years? It's a really good question. And the answer is there is no magic number in terms of what share of your economy you should pay in taxes. And I say this because if you look across the OECD, there are some countries like the Scandinavians or even the UK that pay a much larger share of their income in taxes than we do in New Zealand. So in and of itself, there's no magic number that tells you that by having this level of taxes, it's going to be either great for New Zealand as a country and for our prosperity, and another that's terrible. But there is a but in there, and it's about if you collect those taxes, how are you using it really affects the outcome for the country. So in the Scandi countries in particular, which we tend to look to, they're very focused on devolving that money back into local communities for things like education, healthcare, housing, legal stuff, security, police, and things like that. And so it's not so much that how much taxes you're paying, but it's about what taxes are you collecting, how you're collecting them, and what are you spending it on. That really matters. And it's also whether or not, as a result of not having a large tax base, are you scared of investing in your country? And I think that's kind of been part of the issue in New Zealand, is not only have we been afraid of taxes, and that's fine because you can choose to have a particular level of public services and a particular quality of public services. We've also been afraid of borrowing money for infrastructure investment. And as a result, New Zealand has an infrastructure deficit in the order of $200 billion. And there's a huge pipeline of projects that we need to do. So if you get really, I guess, almost religiously, ideologically wedded to a number, that's the ideal number of taxes, it stops you from seeing some of those other opportunities and trade-offs that if we had maybe 1% more taxes, we'd use that as interest payments to be able to invest in more infrastructure, which might make our economy better. It might make our society better. So um, we're about a third of the country. I think about 30% of GDP is the revenue measure, but there is no magic number that's going to make us prosperous. All right, a question from Kevin Marsh. I'm heading into retirement and easing out of my business over the next 2 years. I have a combination of KiwiSaver, other share portfolio related investments in managed funds, and property. What I need is an overall review of my position, advice on appropriate diversification. For some reason, I don't see simplicity doing this. Am I correct, or do you have people who can provide impartial advice on this aspect of my retirement planning? Kevin, you're right. We're not qualified. We're not the people who can give you that independent financial advice. But there are lots of really good authorized financial advisors who will help you with this wider question that you're asking. And in fact, it's the perfect time to be thinking about this stuff because you're entering into this big life event, which is a really great time to have this conversation. So if you don't have anybody that you can speak to, drop us a line and we'll help connect you to the right resources. New Zealand has a really good range of authorized independent financial advisors who will be able to give you really good advice on all those issues that you are navigating. Unfortunately, that's not going to come specifically from us. And a question from John. Thanks. Appreciate your really thoughtful answer. Agree the unicorn issue is a big problem in your politics. I guess that's not a question, but rather a statement. John, thank you. And I guess this is it, right? I think everything in life is a matter of compromise and trade-offs. There are very few costless decisions. Sometimes we have to find the right balance. To be able to find that balance, we have to be able to come together and to have those difficult conversations because quite often there will be some winners and some losers. And the losers need to be heard, they need to be understood, and they need to also be willing to bear the cost of whatever investments are required. And I think that's how society works. So I think it's really, really important that we understand that these trade-offs are part of life and they're also part of public policy, including in the way that we do budgets. Okay, I've got a question from that was emailed in ahead of it, and that was around what is the difference in returns and risk between the Simplicity New Zealand Cash Fund and a Bank Pi online account? Is it correct that both Simplicity and the banks report return interest rates prior to tax? So they are comparable. Although Simplicity is retrospective and banks are prospective, just thinking about where I could put money short term with maximum returns at minimal risk from the sale of a house for a short period of time until I buy another one. Um, I don't feel qualified to answer this question, so please give our customer services team a quick call because they might be able to help you with your specific situation. Um, I think though, if you're going to use it really quickly, you want to make sure that it's in a really liquid and comparable place. Because interest rates have come down quite a lot in the last year or so, you would have seen the picture in my presentation. There isn't a huge amount at risk, but as you know, a term deposit or a cash fund should protect your downside. But I think it would be better if you could give our customer services team a quick call. They might be able to put you right, better than an economist. Um, it looks like we have reached the end of questions uh, for this member webinar. So unless there are any other questions, I think we can close off a little bit early and let you go to enjoy your lunch break. It's a beautiful day in Auckland, and I hope it is wherever you are. So I think you would have seen the disclaimer that we put on, which is around, I guess it's not specific financial advice for any of you, and that you should go and read the disclosure statements if you have any concerns. But aside from the disclosures, I think it's really, really important that if you have any questions, if you want a copy of the slides, whatever, just give us a call, drop us an email. We're very, very happy to be there with you as you do this. Oh, um, I had a question from Dean around what percent returns is the housing fund targeting? Dean, I can't answer the question because I don't know off the top of my head, but I will look that up and I'll come back to you at the next member webinar, or if you drop us a line, we'll get that answer to you. Okay, so thank you everybody for joining us today. We'll try and do this again next month, and I think next month we'll try and make sure there's Andrew or Sam is available as well to be able to answer some of these other questions that, as an economist, I don't always have the right answers. But as always, if you have any questions, any concerns, give us a call, give us an email. We're there to answer anything that you might have. Thanks.